One of the key things about being an investor is understanding where you're at in the investment cycle. Well, when I started out when I was 20 years old, I didn't have any money. So I looked around and said, well, what am I going to do? I mean, how do I get started as an investor? How do I begin the journey of building my wealth, building my income, building my savings? How do I do that? So you start off with whatever resources you can find. Hopefully you have a little bit of mentoring in the background. And you start saying, well, what can I afford? Well, I can afford to buy some stock. I can afford to buy a mutual fund. I can maybe afford to buy this or that. Well, if I save enough money, maybe I can buy my first house. All of that's very, very smart. But I would say that's the equivalent of being in your infancy as an investor. And then what you hope to do is avoid the pitfalls of different investments, different asset classes, different timing elements that cause you to trip and fall. Now, I can tell you, people have a tendency to get more careless as their net worth goes up. So when you start off and you're young and you're making $35,000, $50,000 a year back in the 1980s and you put $1,000 in savings, that's a good chunk of money at that age. You're a kid, you're learning how, and you put $1,000 aside. When you turn 30 and you're making $300,000 a year and you save 10 or 15 grand, it's not quite as big a decision because you probably already have $300,000 or $400,000 or $500,000 in savings. So if I make a bad decision, I lose 5 of the 10,000, not a big deal. If I lose the whole 10,000, it's not going to change my life. So I can take more risks. So maybe I make 3 or 4 $10,000 decisions when I'm 30 years old, knowing that maybe 2 are super risky, 1's in the middle of the road, and 2 are fairly safe. Well, that's okay because you're at the prime earning capacity of your career. You're cranking, you're making money, you're taking steps up, you're in your 30s, you're healthy, you got young kids, and you're kicking the world's tail and you're making money. Then things change when you get to your 40s, you realize, man, I made a bunch of dumb mistakes. I lost a lot of money that I shouldn't have lost. I took too many risks, too many chances. I still need to make up for those losses. So I'm going to take a little bit of risk, not as much as my 30s, but I'm going to invest in things that can give me that 12, 14, 16% return because I got to make up all those losses because of my bad decisions in my 30s. By the time you get to your 50s, you're like, look, I don't have any more time to make up those losses. I can't chase losses in my 30s or 40s. Even the ones in my 40s, I lost a bunch of money because I was trying to chase with higher yields the money I lost in my 30s. And finally, you get to be 50, you go, wait a minute, whoa. I've lived 2/3 of my life already. I'm probably 65 or 75% through my career. If I want to have any kind of personal life when I get older, I got to make a decision not based on yield. I got to make a decision on preservation of capital. I don't want to lose any money. If I just stop losing money, that's automatically going to double or triple my yield because I don't have a zero in one of my investment columns. So I look at investor maturity this way. It's a combination of age, where we're at in life. It's a combination where we're at in form of professional career and income and earnings and savings and net worth. But it's also a last element, which is a combination of your own personal journey and maturity. I see some people that are in their 40s, they invest like they're 80. They're in money markets and CDs making 3%. And my grandmother takes more risk. But why do they do that? They're afraid that if they lose any money whatsoever, trying to get that 7, 8, 10% yield, they'll never make it back. They have no confidence in their career. They have no confidence in their earning capacity. They'd rather make 3%, maybe even below inflation rate, than even emotionally consider losing money. Okay, you will have money, but you will grow sub-inflation rate and you'll grow at substandard. And what you'll have at the end of the day is money, but you have worked a long time to make far less than what you could have had. Now, the flip side is the person who's in their 40s says, you know what? I still got a good job. I'm still in good health. I'm going to make more money next year. I'm still ready to rock and roll. I'm still a player. I still want to risk money, but maybe not as crazy as I used to be. I won't do so many startups. I'll maybe back off a little bit of the hedge funds, but I'm still a player and I still want to rock and roll. Investor maturity really boils down to you. It boils down to what you want to do, the risk you want to take, where you're at in your earning capacity, and where you're at as far as in terms of the need for more money. If you get to be like some of my partners who are 60 years old and they're worth 20 or $30 million, they're like, I never have to work again. I could pull 200 grand out every single year, pull it out of my principal, live like a king, and have more money when I die than I've ever thought I'd ever have. I don't need to make a dime. You have some people worth $50 to $75 million, and they think they're broke. They got a house and a plane and 2 country clubs, and they're buying businesses and they're rocking, and they're like, man, I got to make 5 or 10 million a year just to keep my standard of living. So I'm worth 50 million, but man, I spend like I'm worth 200 million. And so that individual is pressing the envelope and they're making more income and they're taking more chances. Investor maturity really is an adjective describing an individual. It's your investor maturity. I'll describe mine. I was a high risk taker all the way up until I turned 54. My biological dad died at 55 of a heart attack. I was very well aware of that age. I was very well aware of that pending cliff in my life. I thought, oh God, when I turn 55, I might have a heart attack too. So for whatever reason it was in my brain, I clicked off and said, you know, I have been a risk-taking son of a gun for 30 years. And I can count millions upon millions of dollars that I lost in my own money. And I made a lot of money, but I also had a lot of strikeouts. And I started thinking at 54, all right, if I only have 1, 2, 5 years left, and I'm trying to protect my family, I'm trying to have enough money to live, don't know what my health's going to do, but I'm getting into the later years of my life, maybe I shouldn't do that startup. Maybe I shouldn't do that high-risk venture. And I'll tell you, the hardest thing I found, all the people that normally came to me with deals, I was starting to say, sounds like a great idea, but I'm not interested. What? You're not? No, I've changed my risk profile. What do you mean? You lost your courage? You're not a man anymore? I'm still a man. I still have courage, but now I have experience. And that experience outweighs the courage. The experience says, I'll do 5 startups and I'll lose 4 out of 5. The one that works isn't worth the pain of the gain of the other 4 that I lost. I choose not to be in that arena. And so for a period of about 54 years old to 56 years old, I had a really interesting time telling all the people who have known me for 30 years, thank you, but no thank you, no thank you, no thank you, no thank you, I'm out, I don't do any of that stuff. What I do is this right here. And I simply put my blinders on, put in my directional compass and said, what I want is, number 1, I don't want to lose my principal. Number 2, I want only cash flowing assets. Number 3, I only want long-term assets. I don't want to be in and out of anything less than 10 years. I want long-term assets. I want tangible assets that are real. If I can't see it, touch it, kick it, or feel it, I don't want anything to do with it. Hey, Troy, we're building a resort in Guam. Great, I'm not interested. Why? Because I don't plan on traveling to Guam. And I'm not going there one time. If I own something, I want to see it more than once. If you told me you were building a hotel across the street, I might consider it because I can see it, I can touch it, I can go sit in it, I can feel it, and I can watch it. I narrowed my scope by being very specific that I wanted tangible assets that I could actually see physical contact and I knew what I owned. I also changed the parameters by lowering my standards. I said, I don't need to make 18 or 20 or 30%. I don't need to double or triple my money. You know what I need? I'd like to target 10% return a year. It's high enough it's going to outrun inflation. It's high enough that after taxes, I can pay that 3.5% off that 10% and I still make great yields. It's low enough that the people that are offering the investment haven't had to embellish it. See, to get to 13, 14, 18% yield, sometimes those are really embellished. They add so much nonsense in their financial formula that it looks so good, I just got to do it. Heck, my company has mineral portfolios and working that do much better than 10%. But I look at every investment and say, what is the likelihood, based on what I'm seeing, that I can make at least 10%? If it makes 15, hallelujah. If it makes 20, even better. I just want to know, can it make me 10% return a year, year after year, and my risk is virtually zero of losing my money? Now, that's just a guy who's done this for 41 years. Everyone has their own opinion. But for me to have an investor maturity, I had to mature. And I've carried that over into my business here at Eckard Enterprise by saying, as we build this family business, as we attract and bring in and invite all these millionaires to participate with us, they're going to get the benefit of 30 years of high-risk investment in everything. And that changed and shifted about 8 years ago to something that was exactly what I described. Preservation of capital, 10% return. I want to make sure I can buy it, see it, touch it, kick it, and feel it. Simple, simple, simple cash flowing investments. Now, you may not be like me, but you should be. You may not think you're wanting to be like me, but you might want to change. Because my life has been super, super successful the last 8 years because of what I did. So for me, investor maturity is about knowing who you are today and who you want to be tomorrow. And I'm exactly where I hoped to be 8 years ago when I started this trek. In fact, I'm getting stronger, more disciplined, and even more refined in what I do. It's not necessarily crazy fun because it's quite boring to be successful making money. But I think I'll take being crazy bored over crazy broke any day of the week. Thanks for listening to me.